Welcome to The Flip Side. I'm Brad Rogoff, Global Head of Research, and it's been a busy start to 2026, so it left us with a lot of topics to choose from for this episode of The Flip Side. But we chose one that we thought everyone would be interested in. That's equity markets. So joining me today from our podcast studio in London is Emmanuel Cau, our Head of European Equity Strategy. Welcome, Emmanuel.
Thank you, and good to be here with you, Brad. There is, a lot to discuss.
All right, and before I get into anything, if you want to hear about this and all the topics we discussed this year, do not forget to hit subscribe so you never miss an episode. I already said that we're going to talk about equity markets, but what are we going to talk about with respect to equities? We're going to talk about equity allocations and the merits of international diversification. So international equities have started to outperform the US, and that raises a big question for investors, which is sort of a one-off rotation or the start of a more durable trend. And Emmanuel, I think the best way to do this is maybe to start with a quick recap as to why this conversation seems especially relevant right now. So when you look back at 2025, what really stood out to you in terms of equity allocation and then maybe, relative performance across the globe?
Well, 2025 was a remarkable year for global equities. MSCI World Index was up more than 20% and for the third year in a row. But I think what really stood out was how broad the move was. This wasn't just one or two markets, but Europe, emerging market, Japan, and even the very unloved UK market all outperformed the US. And for the first time in years, the majority of global equity flows went outside the US. So it's not just US driving the show anymore, Brad.
Well, that's interesting that it's not just US, but it's also not just Europe that's driving the show outside of the US, I think is sort of your point. So you're saying you felt like it was really a genuinely broad move when you think about non-US equity markets.
Yes, there was a very broad flow dynamics, and basically were the biggest, strongest equity flows into Europe and rest of the world equities since basically 2010. And that before you even factor the weaker dollar, which has boosted return for US investors buying non-US equities.
Yeah, and from a US investor's perspective, FX actually doing some work to start 2026 as well.
That's right. And look, so far 2026 started pretty much like 2025 finished, with dollar coming down again and most international markets outperforming the US again. So I think the question many institutional investors are grappling with is whether this is just a cyclical bounce or the start of a structural shift away from US exceptionalism.
Look, so it may seem easy for me to take this view because I'm sitting in New York and maybe it's stereotypical here, but I really do think that this was largely cyclical what went on. And if we look back since the global financial crisis, we've only had 2 years where more than half of global markets outperformed the US. That's a pretty long time period. So to me, 2025, it kind of looks more like that catch-up phase. It had to happen at some point type thing. And there was this rebalancing effect, and the starting point certainly helped. We had the Trump election cycle run up in 2024. The U.S. was, it had gotten expensive, I would say, whereas Europe and broader rest of the world were priced for much deeper pessimism.
But starting valuation only explain part of it, don't they?
Well, most international equity markets re-rated in 2025, so their outperformance was mainly driven by valuations, while U.S. returns was almost entirely driven by actual earnings. So at the same time, the dollar weakened partly because of tariff uncertainty, policy uncertainty in general, and partly because the Fed lacked clear leadership. And markets sort of added a risk premium when you think about the US to me. And so I know January felt like more of the same, but now we do have at least a proposed Fed chair in place. The markets seem happy with that. Broader dollar depreciation is no longer our base case from here, and US equity valuations have come down from peaks while Europe's trading at around 15 times earnings, but without the same earnings momentum the US has delivered.
So basically, Brad, you think 2025 was just mean reversion?
That's what I'm saying. A cyclical reset after years of U.S. dominance. So U.S. accounts for more than 2/3 of the global equity market cap. I mean, at some point, you're talking about something that's too big and too liquid for investors to really exit and with no real equivalent or alternative.
I mean, look, it's true that capital market activity and even shareholder culture to some extent is far more developed in U.S. than anywhere else.
And I'd also mention that retail, it's a key source for the bid in the U.S. Almost 70% of household financial assets are invested in equities. No other country has such a strong domestic shareholding base. The U.S. equity market has become the economy, and the wealth effect is a key driver of consumer behavior right now. We talked about that in the last episode, actually, of The Flip Side. So I think the sell America idea, I just think it's overblown. And even though U.S. equities have lagged in the past year, look, the S&P is still up more than 20%. I think people are okay with that. What we're seeing is not investors abandoning the US, but maybe trimming extreme concentration and rebuilding hedges elsewhere to an extent.
Well, Brad, I think what you are seeing is true, but US exceptionalism is first and foremost due to tech. If you strip out the Max 7 stock for S&P 500, the index will be basically flat compared to Europe over the past 5 years. And index return has been highly concentrated, as you know, which means the index is overly dependent on a few mega cap stocks, something more investors are getting uncomfortable with based on our recent interaction with clients. And again, this is what the recent price action is showing up again this year, with tech having a tough start to the year.
So you're really pushing back more on how narrow things are in terms of returns, but not the actual returns. Am I taking that right?
Well, yes, I think the rest of the world indices are far more diversified and maybe somewhat easier to invest in for active manager. I don't think anyone is finding this market easy, by the way, but I think for active manager, positioning through a much more diverse market is somewhat easier to manage. And I think the dominance of passive money in US flows is raising some concerns.
We could do a separate flip side, another point on passive versus active, but that seems to be the issue you're really hitting there as opposed to a regional one.
True, but the passive effect amplifies regional risk when one market is as concentrated as the US. And while AI has become less of a one-way trade, given all the concerns about bubble or overspending or deleveraging or capex monetization, I think investors are increasingly looking beyond tech. And finally, global growth is accelerating, Brad, which also benefits the more value and cyclically tilted international markets. So investors are willing to look beyond tech and broaden out their allocation.
Well, look, personally, I'm not bearish at all on big tech, and actually quite the opposite. You know, I know you and Venu Krishna, our U.S. chief equity strategist, spend a lot of time talking about this stuff, but we don't really see AI as a bubble still. When you kind of look at earnings that should continue to support further upside, even if valuations have come down, and there's certainly some capex questions, but the earnings seem to be there. And after lagging recently, big tech looks relatively inexpensive versus the broader S&P, despite its favorable margin leverage and growth setups. So we're also seeing margin expansion. You look at those names, consensus expects tech margins to rise from 27% to probably about 29% in the fourth quarter. I understand the concerns around the capex, as I alluded to, but big tech's capex as a share of sales, it's expected to moderate after reaching all-time highs in the recent quarters.
Well, that's the dot-com comparison everyone makes, Brad.
And I understand why, but it's far from perfect, right? So even if you look at current levels, hyperscaler capex is around 25% of sales, well below the 40% we saw for major telcos during the dot-com bubble. And leverage is also a fraction of what it was back then. Moreover, if you look at the hyperscalers, many of them are generating enough cash through operating cash flows to invest in AI with one hand, even potentially return some cash to shareholders with the other. And that's a stark contrast to the dot-com era tech infrastructure builders where that cash it wasn't there.
But you see, Brad, that's exactly my concern. If US equity market performance is so dependent on a handful of tech names, then investors aren't really buying US economy. They're basically buying a very narrow team. And that concentration, I think, in itself is a structural risk. And while you don't have to be a bear on tech, by the way, to be a bull on international equities, I don't think Europe or rest of the world performance last year and so far this year was only about what happened in the US, where genuine catalyst elsewhere.
All right, you got to walk me through this, though, because what I see, right, and once again, I know I'm sitting in New York, is a bunch of companies that are still not producing meaningful earnings growth. I mean, the last 3 years, you've essentially had zero earnings growth in Europe, right?
But maybe you should come to London, Brad, because
I'll be there next week. We can continue the debate then.
Look, take Europe, for example. I think what changed wasn't just sentiment. It was the policy backdrop. Fiscal constraints defense spending is going up significantly, and suddenly earnings expectations stop deteriorating. That's enough to matter, I think, for allocators. Now, on top of that, our economies are calling for the GDP growth between US and Europe to narrow, and so far the data is moving in the right direction. And yes, valuation or P multiples have risen globally, but Europe and relative valuation are still extremely low versus history, 30-40% discount. And I think crucially, European earnings are finally set up to recover this year. And as I said, we are starting to see revision trending up. So on a growth and sector-adjusted basis, I think Europe is currently actually very cheap compared to the US.
Well, I think you need that growth to justify the higher multiple. So we'll see if that comes in 2026. But when you look beyond Europe, What are the catalysts there?
Look, I think there are many catalysts. If you go to Japan, the new government is running a pro-fiscal, reflation-oriented agenda. I think that's structurally supportive for growth and equity beta generally. And same thing for emerging markets. I mean, just 1 year ago, Brad, China was called uninvestable. And 12 months later, China has re-emerged as one of the better performing equity markets in the world, obviously with AI and tech being a big driver of that. But China and emerging market equities are still trading on a big discount, 40% discount to the US for pretty much the same earnings growth. We talk about 15-20% EPS growth for the next 2 years across emerging markets.
All right. And so we alluded to this earlier, but when you think about international equities, FX is something you have to think about, right? And it's become a bigger risk with the volatility we've seen recently. So when you look at the last few weeks, I mean, how are you factoring in FX when you think about allocations?
I look, it's a very fair point, Brad, and I think this year is giving us a bit of a headache in terms of cross asset volatility, which is really going through the roof. And FX is always a wild card across international markets. Again, maybe mostly in Japan, but I think it cuts both ways. It can boost returns for dollar-based investors, and it also affects US earnings in some way, given global revenue. And look, finally, again, let's not ignore AI. I think the US is a clear leader, but what drove US return last year was narrow mega cap AI strength. We are starting to see more dispersion, and Asian competitors, particularly in components and infrastructure, are emerging as well. So AI is no longer a US-centric team, with hyperscalers emerging in China and adoption becoming the next hot team, which is very much a global team and not just a US topic.
Okay, so let's say I even buy some of your argument as to why the rest of the world might be getting better. But I'm not sure I buy that as relative value actually improving versus the US.
So backing the US to the end, Brad.
Well, I hope I can do that this summer at the World Cup. I'm a little more skeptical of that, but let's get back to the equity markets, right? And so here's my thesis. So even if Europe grows in 2026, right, which is, as you said, you think there's going to be a pickup, we're seeing some revisions, I think execution risks remain. And I feel like we're already seeing it in Germany a bit. Industrial policy and energy transition, pretty uneven, right? Japan's interesting, but the bond market seems like it's eventually going to act as a constraint on fiscal expansion. And Japanese PEs already back to near their cyclical highs. And on AI, Europe is definitely not leading. So there's no equivalent to the US AI ecosystem. Yes, I'll give you Asia has players. China is certainly ramping up, but the US remains far ahead in both scale and depth. And AI is still the biggest contributor to projected US productivity growth and capital spending across multiple sectors.
That's still the core productivity story.
Yes, plus there's no economy with the same combination of energy security, military leadership, and an emerging critical mineral strategy like the U.S. I mean, these matter for long-term competitiveness, and I think that means that U.S. exceptionalism is still intact.
Look, I have heard that before, Brad, and I don't disagree that the U.S. still leads, but I can't ignore, I think, geopolitical dynamics anymore. The increasingly strong America First policy tilt is starting to unsettle even close allies, and not just governments, by the way, but also global investors. And this is accelerating the trend towards strategic autonomy, countries want supply chain independence, and investors want portfolio independence.
So now you're making a little bit of a different pitch here. It sounds almost like you're saying it's about diversification as insurance, more so than a pure relative value play.
Yeah, and maybe investors forgot too much about diversification in the first place. And I think that's why now we're seeing commodities, which have become one of the most sought after asset classes. Gold demand is rising as a hedge against currency debasement and geopolitical volatility. Base metals and rare earths demand is climbing because of AI data center construction and surging defense spending. And this is where EM and the rest of the world are the biggest beneficiaries. The world is changing, and I think investors have to adapt their equity allocation.
All right, I already said I feel strongly that the sell America trade, which is a big narrative out there, that's not happening. But it sounds like what you're talking about is more of a buy less America trade. Am I getting that right?
Yeah, and I think this is what the flows are telling us so far. And maybe more investors are simply saying, we're not abandoning the US, but we need a hedge. And that hedge increasingly looks like international equities, Europe, emerging market, Japan, or even commodity-linked markets. And the US equity market share of GDP is about 240%, Brad. It's really the same size for the UK, but much smaller for China, most emerging market, and Germany. So there's a lot of catch-up to happen in those parts of the world.
All right, so we've talked about a bunch of macro risks for this trade: FX volatility, policy execution risk, especially in Europe, I think, earnings disappointments if global growth underwhelms, and geopolitical shocks. What am I missing from that laundry list?
Well, I think the biggest risk for rest of the world equities actually comes from the US. And I know, Brad, it sounds almost provocative after the lively discussion we just had. But look, if the US economy were to go in deep trouble, like a recession, I think all economies around the globe will likely get hit as well. And if the US equity market may somewhat finally behave as a safe haven again, in a sense, it is hard to see a proper decoupling between the US and other markets abroad. But who knows? Maybe it could happen. And last year, by the way, during the two episode of tech wobbles, in January when DeepSeek was launched, and in November when investors were starting to worry about OpenAI and circular funding, international equities fell less than the US. So maybe rest of the world, Europe, are high beta to the upside and becoming almost low beta to the downside now.
Well, I don't know. If that's the risk, then I'm not sure how much diversification helps. But I do think you have a general point that is worth keeping in mind. And that's that the debate isn't necessarily US versus the rest of the world. It's concentration versus diversification, potentially. And I still think US exceptionalism isn't broken, but maybe it's a bit narrower than it looks. For many investors, international equities aren't a replacement for the US. They're a hedge against how dominant it has actually become. Well, thanks, Emmanuel, for coming on and covering the entire globe of equities with me today. To learn more, clients of the investment bank can explore our equity view in depth with our latest reports, including our European equity strategy outlook for 2026 and Buy, Sell American. Don't forget to subscribe so you never miss an episode. See you again on the flip side.